The Rebel Capitalist Show.
How does Bitcoin, and I'm going to start with a very generic question, and then hopefully I can hone it down a little bit. But how does Bitcoin go from being a digital reserve asset to money? Towards it's transactional, and we're borrowing Bitcoin. And I'm not talking about I've got 100 Bitcoin and I want to borrow X amount of dollars. I'm talking about I want to buy a new house, and the house is denominated in Bitcoin. Yeah, exactly.
Yeah. We're not there yet. We're a long ways away from that. And I think what's happening is we're seeing that Bitcoin, its use, of course, its use case has evolved as the network has grown. And in retrospect, that should have been obvious to all of us that it would. It started out as a payment currency and then evolved over time to be a better store of value. So it moved from medium of exchange as a primary use back in, say, 2014. This is when I bought my Christmas presents on Overstock.com with Bitcoin back then. Nobody would do that now. It's too transactionally expensive and for small value transactions. And it's you don't want to hold on. You don't want to spend, it's Gresham's law. You don't want to spend your good money, right? You want to hold on to your good money and spend your bad.
And you definitely, if you're a believer that it's going to go up in price, you definitely don't want to borrow it. And then you definitely don't, you don't want to lend it. You don't want to borrow it. So it's kind of this Mexican standoff.
A little bit, but I do think that that's where I'm going is that it's really useful right now as a base money for high value transactions. That's where its use case is right now. It doesn't make sense to buy a cup of coffee with it because the fees are too high. But here's the punchline. We're going to be building layered money on top of it. And it's Lightning Network. It's side chains like Liquid. Those are the sorts of things that basically are netting mechanisms that are anchored to the core, to the Bitcoin blockchain itself. And so therefore they are decentralized. They're more centralized than Bitcoin itself. But Bitcoin itself is not really a medium of exchange. And in retrospect, it should have been obvious that it would evolve this way. What's the medium of exchange is satoshis. And given the cost to transact, you're just not going to buy a cup of coffee with base layer Bitcoin. You're going to buy your cup of coffee with Lightning Network. And that's the sort of thing that I think is going to evolve. And every monetary system, Nick Carter has made this point, and I agree with him. Historically, every monetary system evolved by creating scaling mechanisms that use netting. And the question is the netting done by intermediaries that can create fractional reserve claims to the underlying, which is the way the traditional banking system works, or is it done through mechanisms that are anchored to the base layer blockchain, which is exactly
full reserve.
If they're full reserve, exactly. So you're just netting, you're just transacting off chain to save your transaction costs, but you've created a medium of exchange on top of what is your store of value. But Nick Bhatia wrote an interesting book on this that I haven't completely finished yet because it's so good. And I just haven't had the time, but I will share it here. It's called Layered Money. Nick Bhatia, Layered Money. Take a look at that because he's a traditional financial services person who's also a hardcore Bitcoiner. And he sees exactly this. We're going to end up building layers, just like every other monetary system built layers. There are layers on top of gold, right? The base money itself is the real physical metal, but we ended up layering warehouse receipts to gold in the 1800s in banks in the United States. It wasn't the gold that actually traded; it was the warehouse receipts that actually traded. And then what happened is you ended up with fractional reserve warehouse receipts. Because there was no way to anchor the warehouse receipts to the actual underlying gold. What's powerful about Lightning is there is a way to anchor the warehouse receipt called Lightning to the underlying network called Bitcoin. And that's the point of Nick's book. We are going to end up building layers on top of it. And whether there are intermediaries that are involved or not, we're going to end up, I think, having a parallel system where there are some that are some intermediaries that are Bitcoin based, like Avanti. Our CTO is Brian Bishop, a longtime Bitcoin Core contributor. And then there will be other non-intermediary based transactions where you can transact as well. But you've got to get into the network most likely through an intermediary. And the intermediary is the gatekeeper. So coming back to your original question, that's where those intermediaries are registered with FinCEN. And it's tough for someone who can't pass the identity requirements
but also
to get in.
But also in that world where Bitcoin is base money, contrasting it to the gold standard as an example, like in the 1800s when we had free banking and then we move into central banking. The denomination of what people are trading is still the gold, right?
Exactly.
It's denominated in gold. So if we move into this world where Bitcoin, let's say, is base money, then the house in this example, or the car, or the groceries would have to be also denominated in Bitcoin, or
satoshis,
or a claim, or a claim on Bitcoin.
Yeah, exactly.
You know, so how do we get there with the current volatility of Bitcoin, and how do we also get there if Bitcoin isn't being lent? Because I think that's a key component of the network growing. You know,
see that's where I disagree with you. I'm not a fan of lending. Bitcoin, Satoshi gifted humanity with equity-based money. So why are we piling debt claims on top of it? Part of the problem with the fiat money is that it's credit money, it's debt-based money. And a healthy economy is an equity-based one. If we go back in the United States history, the US was an equity-financed economy until 1968. What do I mean by that? It means all debt borrowed by non-financial sector companies was savings by individuals who consumed less than they produced, i.e. they saved. And the dollar value of savings equaled the dollar value of non-financial sector debt. So on a net basis, they offset. And what we had was an economy that was equity financed as a whole. Now we used credit money, but up until then, it still had a link to gold. Right. And I've always said there's nothing special about gold per se. It was just what tethered the quantity of dollars outstanding. It was just a way to keep a cap on that and not have it grow faster than the total growth in the store of gold that was available. So that's the key is we want to preserve the equity-based money that Bitcoin is. So I'm not a fan of lending. Now, I will qualify this by making the distinction between the same distinction Mises made between credit, circulation credit and commodity credit. That is such a critical point. If you're not familiar with those terms, go dig into Mises and go read about them. Commodity credit is debt that's backed by real savings. Circulation credit is what we would call fractional reserve banking type credit. It's more claims, it's paper claims, more paper claims than there are underlying assets. So Mises was not opposed to debt, and I'm not either. I'm making a critical distinction here that the character of the debt matters. So we could have Bitcoin lending markets that allow you to go up to 1-to-1 loan to collateral ratio. In other words, you can lend up to 100% of the value of your coins. But once you go above 100% of the value of your coins, now you're turning it into a credit-based money. You're turning it into what gold ultimately turned into, where there are more paper claims than there are physical underlying. And what that does is it suppresses the price. So I've not been a fan of all this leverage-based financialization that we've been seeing in Bitcoin. I am not a fan of these 100-to-1 leverage futures markets, or even a lot of the Bitcoin lending that's happening. That is Wall Street bringing old thinking to an equity-based money system. But as I've been writing about this very topic since 2016. There's if you're interested, dig into some of my Forbes articles that came out right about the time that backed a subsidiary of ICE, a sister company to the New York Stock Exchange, announced that it was going to start listing physical settled Bitcoin futures. And I warned at the time, oh no, here comes the bad financialization, the leverage-based financialization, because Wall Street's going to bring Wall Street thinking into Bitcoin. But here's the punchline on that. Bitcoin gets the last laugh because there's no one who's ever going to make more Bitcoin. And these Wall Street firms are going to get themselves leveraged and over their skis. And there's going to be a run on Bitcoin, and they're not going to be able to find the underlying base collateral that they need to deliver into their leveraged contracts. Nobody's making more than 21 million Bitcoins.
Right, and there's not enough velocity.
Exactly. And we're really seeing a shortage of Bitcoin. I follow a couple of interesting folks who track the number of Bitcoins that are available on exchanges. Bitcoin is pretty scarce. And during bull markets, it gets even more scarce, which is part of the reason why the price goes up. Duh, economics work. But a lot of coins get withdrawn off exchanges. During a typical cycle, you'd see maybe 20% of the Bitcoin and Ether owned on intermediaries, held by intermediaries like exchanges or the futures or lending companies, the derivatives platforms and lending companies. But when you see the big price spikes, that plunges down into as low as single digits. There's just not that much underlying collateral available. And if you had a big intermediary that had a classic run on the bank because they got themselves fractionally reserved and suddenly they had to actually deliver the real base layer underlying Bitcoin. Oh boy, that could hit a wall very, very fast, and Bitcoin could spike in price. And I have said this as well. I've spent a lot of time in the last couple of years working with mainstream regulators, and I've warned the bank regulators. I've been warning since 2016 that Bitcoin will take down a global systemically important bank, a GSIB, global systemically important bank. Bitcoin will take one of them down. And it's not because of anything wrong with Bitcoin. It's because the traditional Wall Street people who have invaded our sector in a big way are bringing the leverage, the circulation credit type of debt into the Bitcoin market. And they're thinking that Bitcoin is just like any other asset. It's not. And we will get the last laugh. The hodlers will get the last laugh when they're desperately trying to find collateral into a market where it just doesn't exist. And yet what they're doing to us right now is suppressing the price. There is no question that when you create artificial claims to an underlying asset, and there are therefore more claims to the underlying than there are real underlying, what does that do? You're just think back to your supply demand curves from your economics class. If you create an artificial supply of something, all else equal, it pushes the price down. And that's what's happening. We are starting to see the Bitcoin price suppression, just like there's been gold price suppression. And so the way I look at all of this circulation credit craziness that we're seeing in Bitcoin right now, of which I'm very critical, is that this is suppressing the price, and those who are stacking sats, those who are accumulating Bitcoin right now, are getting it at a lower price than it otherwise would have been. And eventually the top's going to blow, because there will be Wall Street firms who have to learn the hard way that Bitcoin isn't like any other asset they've ever dealt with. Some may challenge me and say, well, why is Bitcoin that different from gold? There's a finite supply of that too. And I would agree with that, but here's the difference. Wall Street controls most of the gold in the world. And by Wall Street, I'm talking about all the global banks. Same thing with central banks and the LBMA. Those are banks. They control the underlying collateral. Most of the gold is not owned by individuals. The opposite is true with Bitcoin. Most Bitcoin is owned by individuals. Wall Street and intermediaries do not control the vast majority of Bitcoin, and never will. It's way too late for that. And that is why I think there will be hard lessons to learn from traditional Wall Street banks. And to be fair, I'm trying to warn them, because a lot of their traders want to get in and just start leveraging it and trading it. And I'm trying to warn them and warn the risk folks in particular. This isn't going to end well for you if you think Bitcoin's like any other asset.